Thank you. I appreciate it. And I appreciate everybody coming out on right in the middle of the trading day, which is, to be honest, quite an interesting trading day. We've had coming off of a long weekend, and the markets are a little unruly in some situations, especially if you're short energies. So we'll make it, hopefully, this is a very timely presentation because we're going to talk about hedging a stock portfolio. And as we all know, the stock market has been screaming higher for the last handful of months. In fact, this is one of the biggest and fastest rallies we've ever seen in stocks. Only time will tell whether it continues or not. The odds are it probably won't end well, but that's just how markets are. Sometimes they break away from fundamentals and it becomes a momentum trade, and it's hard to stop that sort of thing. But let's talk about how you might protect your portfolio just in case the music does stop. This is my contact information. If you have any questions or comments or concerns, you can reach me at that phone number or that email address. You can also visit our website, decarlitrading.com, for additional educational material and information on our brokerage services. We are a futures and options brokerage. That's how we make our living. We offer everything from full service to discount online and everything in between, to be honest. If you are on social media, check us out on Twitter, Facebook, Instagram, and YouTube. We have about 30 or 40 videos on YouTube. I always talk about my Instagram feed and how I post dog pictures, and I receive requests for dog pictures in the webinar. So here we go. This is Frankie. Believe it or not, this is just right outside Las Vegas. We do have mountains and trees here and even some green vegetation. I know it's hard to believe. If you are interested in learning more about futures and options trading, the good, bad, and the ugly, I've tried to incorporate all of that in these books. As we all know, commodity trading is not easy. It's speculating. We're trying to beat the markets, and to be honest, it's a difficult game. So these books will not sugarcoat it. We're not promising get rich quick kind of stuff. This is the reality. If you go to Amazon, you'll find these books are cheapest on Amazon. They're also available on Kindle. You'll see several other books that I've written. Don't bother with those. Only focus on these three. The others are outdated or with older publishers and rewritten. So don't worry about the others. And one more quick thing, if you are tech savvy and you like the idea of mobile phone apps as opposed to email and things like that, you can also get in touch with us via our mobile app. If you just search DeCarly Trading in your app store, you'll find it. The app itself is free, and you can sign up for a free trial of the client content, which would be newsletters, trading ideas, that sort of thing. And one more thing real quick, I just want to make sure, again, I've already mentioned, but I just want to make sure you fully understand. Trading is not suitable for everybody. There's a substantial amount of risk involved. So let's talk about hedging. Hedging is the practice of taking an offsetting position in a related asset or security to reduce the risk of adverse price movement. Although most people come to the futures markets to speculate, and some speculate using massive and unreasonable amounts of leverage, that is possible. But believe it or not, the futures markets were actually created to hedge. The idea is hedging basically shifts the price risk from the hedger to the speculator. Hedging is similar to purchasing insurance, depending on how you go about it. As a consumer, you're shifting your risk from yourself to the insurance company. In the same manner, if you're trading options on the futures markets, and we'll show you some examples soon, you're basically shifting your price risk from yourself or your portfolio to somebody that's willing to take that risk. That person's generally a speculator. So if you're reading a college textbook or any type of literature really on hedging, they assume that there's such thing as a perfect hedge. But in my opinion, there really is no such thing as a perfect hedge in reality. If there were such a thing, you would basically eliminate all of the price risk. You'd have zero price risk, but there's always an opportunity cost, right? There's nothing in life is free. If you are removing risk from yourself, you're giving it to somebody else, and there's going to be a cost for that. But the reason there is no perfect hedge in existence is markets are not perfectly efficient. Assets are rarely perfectly priced, and we have to deal with transaction costs, slippage, contango, all kinds of things that interfere. But nevertheless, even though you can't perfectly hedge your portfolio, having some sort of hedge is probably a good idea when markets are at extreme levels. Like I tend to believe that the S&P is at an extreme level here between 3,900 and 4,000. To be honest, I thought that about 100 points ago, maybe even 150 points ago, and we're still continuing higher. So that's the thing with speculation. Picking on the exact high or low is going to be very difficult. So the idea of what we're going to talk about today, we're going to give you a couple different strategies, with one in particular that I think makes the most sense, that will give you some upward momentum in your portfolio, but also put a floor underneath it should something change in the trend. So if there was such thing as a perfect hedge, it would be something like this. Basically selling a futures contract for the value of your portfolio. If your portfolio happened to be exactly $190,000 and you sold one E-mini S&P at 3,800, and how I came to that figure is each point's worth $50. So if you multiply 3,800 times $50, you come up with 190,000 for the contract value. Of course, that contract value fluctuates as the market goes up and down. Assuming that you had exactly 190,000 worth of S&P stock in your portfolio and you sold one futures contract at 3,800, in theory, it would be a perfect hedge. As the market drops, you're making money on your short futures position, but you're losing money on your portfolio and vice versa. In theory, if everything went perfectly, you would have zero price risk because you're making on one hand and losing on the other. And of course, we've just discussed that's really the odds of your portfolio being exactly 190,000 and you selling at 3,800 exactly are pretty slim. So it's generally going to be a rough hedge, not a perfect hedge, but that's okay. One thing to keep in mind, if you were able to put on a perfect hedge or a near perfect hedge, let's say you sold your future at, who knows, 3,900, which is roughly 195,000, but you only own, let's say you own $200,000 worth of stock. Obviously, that's not a perfect hedge, but it's a pretty good hedge. And in theory, you're basically taking most of the price risk away while you're still earning dividends on your portfolio. And you might be avoiding a taxable event. As a stock investor, there's definitely situations where you have to time your entry. You don't have to, that's not the right word to use, but some people attempt to time their entry and exit and profit taking and loss taking because of tax consequences. So this is a way to maybe exit your position for the most part by selling a futures against it, not creating a taxable event in the stock market, but still enjoying your dividends. Stocks tend to go up over time. With that in mind, you really shouldn't be willing to forego all of your upside profit potential, or at least that's my opinion, because you're betting against the odds. Of course, there's big corrections here and there in the stock market, but generally speaking, stocks almost always go up. There's been a few decades where they've gone sideways, but again, in the overall scheme of things, the odds are over time they will move higher. So with that in mind, a partial hedge is probably ideal because it offers some downside protection without forfeiting upside profit potential. Also, you're going to probably want to hedge a little more aggressively when stocks are expensive, like they are now, as opposed to when stocks are cheap. For example, in March of 2020, hopefully in a perfect world, hedgers would have been taking profits on their hedges or pulling hedges off, not putting them on. If you're trying to hedge your portfolio after the fact, you've probably missed the boat. You'll probably do more harm than good. But if you're trying to hedge when things are good and rosy, like they are now, you might help yourself out a little bit. Even at the very minimum, take some of the stress away from things. So a partial hedge, if you're using futures to hedge, might mean selling a smaller amount of futures as relative to the stocks you own. For example, if you sell one E-mini S&P, you're hedging 190,000, but if you own $300,000 worth of stocks, you're leaving your upside open on roughly a third of your portfolio. Another way to partially hedge is to buy puts, sell calls, or both. This is my preference. I think that makes the most sense for most people, is to sell calls and then use the proceeds to pay for puts. And we're going to go over some examples. I know this is a lot to shove into a couple slides, but we're going to show you some examples so it'll be a little easier to comprehend. One thing I want to keep in mind is I'm doing most of the math based on an E-mini S&P futures and options in these examples. But if you're trading a smaller portfolio, or I should say you need to hedge a smaller portfolio, or you're trying to pinpoint your hedges, you can use micros in addition to minis or instead of. So for example, if you had a portfolio of stocks worth about 19,000 that you wanted to hedge, you could sell one micro as opposed to selling one mini. Let's say you had $220,000 worth of stock and you wanted a mostly complete hedge, you could sell one mini and one micro. So you've probably guessed that the micro is 1/10 the size of the mini. So that's where I'm coming up with those ratios. But between the two sizes of contracts, I think any investor of any size or type can probably find a reasonable hedge. The most popular form of hedging is buying puts. You hear this all the time. If the market starts getting expensive, traders say, well, I'm buying puts to protect my downside. And on paper, that's probably sounds like a decent idea. It makes sense. But the problem with that is, as humans, we start to believe the market's overbought generally far before it actually corrects, right? We're generally a little early to the party. I know with my analysis, in March and April, we were bullish the S&P, which was an unpopular opinion. But our target was about 3,700 to 3,800. And when it got there, we started thinking that things were going to turn around. Of course, they did not. They've continued higher. First of all, we can't see the future. Second, we're humans and we're emotional. The timing is never going to be perfect. If you're using long put options to insure yourself for 2 months, 3 months, or even a year, while you think maybe you need some protection and you can sleep better at night, it's going to be really expensive. Also, if you are a put buyer, puts expire, right? Options have limited time frames. So you're probably buying puts at least 3 or 4 times a year, maybe even more often if you're buying monthlies. And during that time, you're subject to time value erosion. In many cases, you could end up spending more money on your puts to protect your portfolio than you actually make in the portfolio. So to kind of drive the point, options are priced to lose. They're really great if you happen to have one on when you need it, but the odds are they're going to expire worthless. So if you're buying puts, it's going to be really costly and you may not even benefit. And the reason being, and again, we'll show you an example later, a lot of investors that are hedging with puts tend to buy the put and then never cash it in. So let's say that you purchase a put and the market drops sharply, your put is making money, but if you never sell that put and lock in the gain, you did absolutely nothing but make yourself feel better for a couple of weeks, but monetarily, you did nothing for yourself. In fact, you actually hurt yourself. So in my view, when you're purchasing put options outright, it's kind of like purchasing catastrophic insurance. It comes with a perpetual cost and it rarely pays off. Here's an example of some prices that I took a couple of weeks ago. These are March E-mini S&P puts with 50 days to expiration. The futures at the time was trading at 38.50. So a trader that wanted to hedge his portfolio for the next 50 days, which is less than 2 months obviously, would spend 45 points or 22.50 on a 35.50 put. In other words, if you held all the way to expiration, that put would not pay off unless the S&P was below 35.05. So the market would have to drop well over 300 points just for that trade to break even or even make a little money as your hedge. Is it getting you peace of mind? Yes. Is it getting you real protection? Probably not. Similarly, you could have bought the 3,300 put for 21 points or roughly $1,000. The S&P would have to be dramatically lower for you to, whoops, I didn't update this number. That figure is incorrect. It's not 2735, obviously. Here, this is incorrect. It should be basically like 3280 instead of, so that's incorrect, just as an FYI. But the point of this slide is, if you're buying these types of put options, you're paying roughly one, maybe even more, 1% to buy your put option. If you did this every 3 months, you'd pay 4 or 5% of your portfolio annually to protect it. Now, you're only protecting yourself from a decline below of 300 or more points. That happens a handful of times a year, but it generally doesn't decline more than that. Sometimes it does, but often it doesn't. So can you imagine putting up 4% of your portfolio every year for 10 years, the damage that might do to your portfolio? It's substantial. I mean, we're a little bit spoiled right now, but historically, the S&P really only makes about 10% a year in the very long run. So let's assume the S&P makes 10% a year and you're giving up 4 to 6% of that with protection, and then maybe another 1% of that if you're paying an advisor or transaction costs or slippage or any of that kind of stuff. It's really not much left. So you're taking a whole lot of risk and not getting a payment on that risk or not getting a return on that risk. Okay, so let's give you an idea of what a long put hedge would be. And this is what I was just describing to you. Buying puts are expensive. This particular trade is purchasing a 3,700 put with 35 days to expiration. So this is only going to protect you for a month. The market at the time of this was roughly 3,900. It looks like maybe 3850. We'll call it 3850. But anyway, the market's got to drop 150 points just for this hedge to pay off. And in this situation, because of the way that the options are priced and the VIX was somewhat elevated, you're basically giving up 1% of your portfolio to protect yourself for 30 days. And it's only going to pay off if the market declines 6% or more. So this is really, really expensive. You can see here, the odds of this option expiring worthless is this entire area here. If it's 3,700 or higher at expiration, your insurance expires worthless. The only way it pays off is if the S&P drops below the recent low, which is possible, but is it necessarily likely? Probably not. Is it worth spending that kind of money, almost $2,000 on? Probably not. We're going to show you a better way. Don't worry. So let's look at a chart of a short futures hedge to give you an idea of what that might look like. So the margin on the S&P right now, an E-mini S&P, is 12,100. If you traded the micro, it would be 1,210. So again, the micro is 1/10 the size of the E-mini. You can use micros to do any of the stuff that we're talking about here when we're discussing the E-mini, just on a smaller scale, obviously. So if you sell a futures contract at 3,900, this futures contract is going to protect your portfolio dollar for dollar below. But above 3,900, your sales price, your portfolio will gain in value, but your futures hedge is going to lose. So this is what we would call a relatively perfect hedge if you were hedging $195,000 worth of stock at that price. The nice thing about this is you have zero price risk and you still collect dividends. If your portfolio is paying 1.5% to 2% in dividends, you're all set. You have very little price risk, but you're getting dividends. Now, if the market continues higher, let's say we're wrong and 4,000 isn't lofty in the S&P. Maybe we see 4,200, 4,300. Who knows where the end might be? You're giving up all of this upside potential. Another thing to keep in mind is if you are hedging with futures, even though your price risk is somewhat eliminated or mitigated depending on the details of the hedge, you're still going to have margin in a futures account to hold this hedge. So nothing in life is free, right? Even though you've locked in your price risk, you are still responsible for keeping margin in the account. And if the S&P futures go against you, even though you're making money in your stock portfolio, you're losing in futures and your futures broker is going to want you to pay up. And this is true even if you're dealing with a broker dealer that allows you to trade both in the same account. It's technically not the same account. It's technically two different accounts and they sweep money back and forth. So just keep that in mind. So I think the most efficient way to hedge a portfolio is with risk reversals, and let's talk about that. So is free insurance possible? I just told you nothing in life was free. Well, kind of. So it's free in terms of money, but not free in terms of opportunity cost. So let's talk about this. Perhaps a smarter way to safeguard an S&P 500 portfolio is through the use of out-of-the-money risk reversals. This means buying puts equivalent to the amount of stock exposure that you want to hedge, then selling the same number of call options to pay for that hedge. An investor willing to have a partial hedge could do fewer contracts. The result is basically getting put insurance in place without any pocket of expense. So technically it's kind of free. The opportunity cost is you forfeit any stock gains above the strike price of the short call. And as I mentioned before, you have to have a margin account available and you have to have margin funds in the account to hold that hedge. in essence, you're basically mitigating your downside risk in exchange for capping profit potential. So when we say free insurance, we mean no out-of-pocket expense, but there are other costs. The first cost is opportunity cost. You're giving up the upside potential on your stock portfolio. The second thing is margin costs. Again, just like with the futures hedge that we spoke about a minute ago, your futures broker is going to require you have margin to cover the risk of being short a naked call. In your futures account, it's considered a naked call, even though you have stock in a different account that's appreciating as the market goes up. The margin on a risk reversal trade like this can be anywhere from $5,000 to $12,000, depending on the strike prices used, the volatility, so on and so forth. So realistically, if you wanted to do this sort of hedge, I would say you probably at least want 20, 25,000, maybe even 30,000 in an account available to do this sort of hedge. So while the insurance itself is free, there's definitely some opportunity costs. Something I'll point out, I am a commodity broker, obviously, so I'm biased, but what I'm going to tell you is if you're going to do this sort of thing, make sure you're trading with a broker that's capable and willing of this type of strategy. Not all brokers will let you sell call options, even if you have the underlying stock in a different account. Not all brokers will allow you to sell call options at a reasonable margin. A lot of them will upcharge the margin, and it'll basically make this type of hedge strategy almost worthless, not worthless, but much more expensive to employ to a point where maybe it's not worth it. So if you're going to do this sort of thing, make sure you're with a commodity broker that knows how to handle this sort of strategy and will give you the exchange minimum margin, so on and so forth. So here's an example of what a risk reversal might look like to a trader. In this particular situation, the nutshell is the trader's giving up any gains over about 2.5% in exchange for hedging any decline that is beyond 5%. So again, it's a free trade. In fact, this particular trader, what he's doing is he's selling a March 4,000 call, and then he's buying a 3,700 put. He's collecting 42 points for the call and paying 37 for the put. This means he's actually getting a credit. So the market is paying him $5 or $250 per contract to hedge about $190,000 worth of S&P stock. Again, free insurance. The only thing you're giving up besides the issues I mentioned with margin accounts and keeping a balance and so on and so forth in your margin account is if the S&P goes above 4,000, your portfolio is capped. But this particular hedge lasts for roughly 30 days. If the S&P goes more than 2.5% higher in 30 days, that's a pretty fair bet, right? Annually, we just said that the S&P generally travels about 10% a year on average. On a good year, it might be 20%, but 2.5% in 30 days, that's not too bad. In order for the market to keep up that sort of pace for 12 months, it would be a 30% year. So it's not a bad trade-off is all I'm trying to say. If the market does fall below 3,700, there's basically a floor on your portfolio. Your portfolio would be covered dollar for dollar, assuming you have the correct stock allocation, below 3,700. There's not many other strategies you can do in which the market will pay you to hedge your portfolio. Now, of course, it's not perfect because you're giving up upside, and again, you have to have the right broker and a properly funded account to do it. One other thing I want to point out, I know we're a little short of time, but timing matters. Do not fall into the trap of thinking that if you're hedging, timing is irrelevant, because that's absolutely not the case. You should be putting on hedges when you think you don't need it. For example, now it's very hard to find anyone that's bullish the S&P. This is probably the time people should be focusing on hedging their portfolio, not adding risk. Also, the timing of exit is just as important. Hedges need to be offset or reduced as the market moves lower. Otherwise, there's no point in having a hedge at all. I'm going to show you a pretty eye-opening slide. This is during the correction of 2020, March of 2020 last year. And you can see the red here, this is the June 2600 put. Prior to the correction, it was worth 10 points. At the peak of the correction, it was worth about 500 points. This means on somebody that would have purchased insurance, a put option for $500, in February before things fell apart and sold it. And of course, I'm not saying somebody bought the low and sold the high. I'm just saying, as an example, this is what this option experienced. This would have been a $24,000 paper profit on their hedge. However, if that same person failed to take any profit on that hedge, it would have expired worthless. So hedges only count if you actually lock them in. Now that's hard to do because let's say that this option went from $10 to $100 and you thought that was fantastic. You just hedged your portfolio for this big drop and you thought let's lock it in, it's over, and the market continued lower. In that situation, it would be frustrating to watch that protection that you sold for 100 points go to 500 points. But there's a few things to keep in mind. You're still 90 points better off than you would have been if you had no hedge. So that's something. Also, and that's, I mean, to put that mathematically, that's roughly, we'll just say $4,500. Not the perfect scenario, as we can see, but nobody can see the future. So it is what it is. Something is better than nothing, right? And also, the odds of this second leg of the drop happening again or anytime soon is probably pretty slim. So nobody could have seen that coming, I don't think. Anyway, but the point is, if you have a hedge and it makes money, be sure to lock some of it in, because if you don't, it's probably going to expire worthless. Timing is everything. When the ES is moving higher, calls are generally overpriced and puts are generally underpriced. This is what makes risk reversals a really great way to hedge. If the market's overbought, like it is now, you're selling the call options for top dollar and you're buying the puts on sale. This gives you a better result if things do turn around. You're going to get basically more action on the options. You're going to get a higher break-even point. In other words, your protection will kick in at a higher point, and you're less likely to incur margin issues in your futures account. If you put on a hedge when you need to, you're going to be in trouble if you put it on in a hole. So for example, let's say the market's in a trough and you sell a call and buy a put and the market reverses, you're going to be in deep trouble. So as long as you're putting on this type of a hedge strategy when prices are lofty, hopefully you keep yourself out of that situation. In other words, hedge when you can, not when you need to. Don't wait for the house to be on fire to start doing something about it. I'm out of time, but if you have any other questions or anything, please visit our website, decarlitrading.com. You can sign up for free trials of our newsletters. You'll find educational content and material. If you're interested in learning more about option trading, we cover these risk reversals that I just talked about in my latest book, Trading Commodity Options. The website's tradingcommodityoptions.com. So thank you. Appreciate it.